A 6.5% investment grade bond. Would we invest in it personally? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So this 6.5% triple B rated retail note, corporate bond from Jefferies Financial Group is the highest yielding investment grade bond on Fidelity's platform this week. And given the attractive coupon, we've gotten quite a few member questions about it. Is it too good to be true? This new issue is only available at par value on Fidelity until Thursday, March 27th at 11:30 a.m. Eastern Time. So given the short timeline, in case you want to buy it, here are the 3 topics that we'll be covering in today's video. 1. Who is Jefferies Financial Group and where do they come from? 2. How did Jefferies do in 2024? And 3. Would we personally invest in the 6.5% retail note? At the time of this taping, this Jefferies bond is also available on Schwab, but not on Vanguard. As usual, here's our front of video disclaimer, and in particular, this last point remains as valid as ever. This content is not sponsored by any of the companies that may be mentioned in this video, nor do we receive any compensation from them if you choose to do business with any of them. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Who is Jefferies Financial Group and where do they come from? Jefferies describes itself as one of the world's leading full-service investment banking and capital markets firms. It is headquartered in Midtown in New York, has a balance sheet of $64 billion and about 6,000 employees globally. Jefferies is also listed under the ticker JEF on the New York Stock Exchange with a market cap of around $12 billion. But before we jump into their performance in 2024, let's have a look at where Jefferies comes from, because they are a relative newcomer to the big world of investment banking in New York, which probably explains why they are well known in financial circles, but may not really be a widely familiar household name yet. Jefferies was founded by Boyd Jefferies in 1962 in Los Angeles as a small equities trading shop. They kept growing with some ups and downs, but then they really took off in 2001 when Richard Handler became chairman and CEO and moved the headquarters to New York. Handler is still currently the chairman and CEO, and he's a bit of a legend on Wall Street. He's well known for his informal personal style, such as when he brought his mother along to a business event in Florida. And there's probably not another CEO on Wall Street that would have brought his mother to the event being hosted by an important client, as the Sydney Morning Herald reports. But Handler is also famous for a business approach that can be described as either driven or by some competitors as having a competitive eat what you kill culture, as the Wall Street Journal writes. Perhaps that's what it takes to break into the top league of investment banking against all the larger and more storied competitors. In any case, Jefferies has built out a strong position in many markets, not least of all in areas such as healthcare and middle market banking, often serving mid-sized companies that need professional investment banking products and services, but may sometimes feel a bit too small for the largest banks. As Jefferies proudly points out on its website, they have grown into ranking at least 8th globally across all investment banking products. And it seems that neither the firm nor Handler are ready to slow down. The Wall Street Journal summarized it as recently as October 2024. Wall Street's scrappy underdog has an ambitious plan to make it big. Now that you have this background on Jefferies, let's move on to the next section of today's video to see whether Jefferies did well enough in 2024 for you to consider if this 6.5% corporate bond may be something you might want to invest in as part of your overall diversified portfolio. How did Jefferies do in 2024? Jefferies is a financial year that ends in November, and we're very close to the publication of the results for the first quarter of their new fiscal year 2025. However, given that the deadline of March 27th at 11:30 a.m. Eastern Time for potentially buying this 6.5% retail note is approaching fairly soon, as I mentioned before, we'll still have a look now at the last available numbers for Jefferies' full year 2024. These numbers for 2024 should give our Diamond NestEgg community a suitable starting point for analyzing whether Jefferies may be able to serve their debt fully and on time going forward. And this even more so as Wall Street overall, in an aggregate view across individual analysts that is called a consensus forecast, seems to expect their earnings to grow from the last results. So let's dive into Jefferies' 2024 numbers now. Overall net revenues for 2024 were a little bit more than $7 billion, up pretty much exactly 50% versus 2023's $4.7 billion, and still up a respectable 18% versus 2022's almost $6 billion. So Jefferies' business was growing successfully overall. That said, the high growth rate in 2024 from the previous year also tells us that 2023 wasn't that great a year for Jefferies. And indeed, it was down significantly against 2022, as you can see here. This reminds us that Jefferies is really almost as pure an investment bank as it gets. They have a little bit of asset management revenue, as you can see here, but everything else is mostly different flavors of investment banking and capital markets revenue, which can be notoriously fickle and volatile. Another side effect of being an almost pure investment bank is that Jefferies, unlike competitors JP Morgan or Morgan Stanley, does not have a retail or corporate bank and has no direct access to deposits from customers like you and me. This means that it has to raise much of the cash it needs by selling bonds and similar instruments to the public. So we may continue to see their bonds being offered more or less regularly to retail customers like us going forward as well. But back to Jefferies' financials for 2024. Expenses were steeply up, especially employee compensation and benefits, as you can see here. However, net earnings after tax, the bottom line, so to speak, still nearly tripled for 2024 to $712 million versus only $262 million a year ago. That said, it was still below the $781 million that Jefferies had made back in 2022, which serves as yet another reminder of how volatile investment banking results can be. Many credit analysts currently seem not to be too concerned, though. As of the latest creditor and counterparty overview that Jefferies has posted on its website, all three large credit rating agencies, Standard & Poor's, Moody's, and Fitch, rate Jefferies Group as investment grade with a stable outlook. Of course, I'm speaking here from a bond investor's perspective, someone who is mainly concerned with Jefferies being able to service all of its outstanding debt fully and on time. An equity analyst looking at the development of their share price might come to a different conclusion. But we can save the equities discussion for another day if there's enough interest, which brings us to the next section of today's video. Would we personally invest in the 6.5% retail note? Always keep in mind the three investing mantras that you hear so often on this channel. 1, and straight from our front of video disclaimer, past performance is not indicative of future results or events. 2, our trademark saying, everyone's financial journey is different. And 3, higher risk, higher return. This higher coupon you get from Jefferies versus a treasury is because you are assuming a higher risk. There's just no way around it. And remember, these bonds are neither insured nor guaranteed. You as the investor carry the ultimate risk of any delayed or reduced payments, or even, worst case, an insolvency of the issuer. That said, a 6.5% coupon for an investment-grade bond can sound attractive in times when we're discussing treasury yields with a 4 handle, or even below. Plus, if we look at other banks, even large ones are currently paying yields that are not worlds away from Jefferies. For example, about 10 days ago, we shared with you this retail note from JP Morgan Chase, which had a coupon of 6%. But of course, you need to be comfortable with Jefferies' underlying business model, the potential volatility of the business and its earnings, and any other possible risks. For example, if the economy enters a recession. Personally, I am comfortable with this. And if I were a bit older and looking to move more of my money into longer dated bonds for a stable income stream, this is one I would invest in as part of an overall diversified portfolio. But then again, both Marcus and I grew up in investment banking and financial services, so this is not a field that's completely alien to us. Your circumstances, goals, and expectations may be different. Do remember as well that this Jefferies bond has a first call date in March 2026. Here's the QSIP in case you're interested. And if you are comfortable with Jefferies, but are looking for something with a first call date that is further out, this one here has a first call date in March 2028. But the coupon is 50 basis points lower at 6%. Here's a QSIP in case you're interested. So what do you think? Are you considering a Jefferies retail note? And if yes, do you prefer this higher yielding 6.5% one with a first call date next year, or this lower yielding 6% one with a first call date in 3 years? Drop a comment below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about treasuries, corporate bonds, or bond investing in general, then check out this video here on our bond courses. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds this coming week. And see you again very soon with more brand new wealth building content for your financial journey.